Oh, what's going on here? Huh. Hold on a sec. Okay, we're good now. Just have to get the appropriate graphics going. How you doing, friends? This is Coach Ernie, and this is the 0DTE morning. I'm sorry, the 0DTE and tail risk macro analysis morning analysis report. That's a mouthful. I'll come up with a better title. But every morning I do this total macro analysis to figure out what our 0DTE and fat tail trades are going to be. And as you may already know, if you don't, the 0DTE trades that we do are out of the money butterflies. They're so far out of the money that most people look at them and go, what's that? But in fact, it is part of the family of fat tail or tail risk trades that we do here in our coaching service, and also what we do on our Skool communities. If you want to know more about that, go down below into the description and click on that and learn all about fat tail trading and our AI trading assist. It's more than just assist. So anyways, a fat tail trade is one where we're looking for tail risk events. And on the 0DTE, we're taking advantage of the fact that options decay at their most rapid rate on that very last day of expiration. But we're looking for an asymmetric trade where there's very little risk, large potential upside, and so that's the nature of that trade. It's very cool. Keeps your volatility returns way down. It's a dream trading because there's absolutely no stress. You're never drawing down, and you're just waiting for those big events, and you make good money, positive, consistent returns. Who doesn't want that? No stress and positive returns, consistent. So our other tail risk trades, the way they differ is by the length of time that we're in them. So in the very short term, we have 0DTE, 1 day. And in some cases, when the volatility gets low enough, that 0DTE trade will turn into 1 or 2 DTE. We call that the time warp strategy. As we go further out, we can start approaching what most people might consider swing trading, I guess. And we have a strategy going from 3 to 5 days. We call that the convexity stack. They're just names. Don't worry about what the name is. And then a little further out, 5 to 10 days, and that's called the sigma drift. And then we start doing the much longer term things, looking for much larger existential risk events that will happen. There is a 10 to 30 and a 30 to 90. So all of those are the complete lineup of our tail risk strategies. And so I report every morning, giving you the setups for the 0DTE, and then also a macro report that will set you up for the other longer term ones. So that's what I do. And every morning I put out a report that I actually read from. So let me just tell you what the story is. So if I'm a trader, right? Let's say that you're a professional trader. This is what you would normally get. You get in the morning and you start doing your morning analysis, and some team of analysts are putting together all your information and then preparing it for you, this nice, beautiful little report, putting it right in front of you. Well, we do the same thing, only our report is better than that team of analysts, because we've created tools that, with just a few clicks of a button and a simple prompt, gives us this beautifully formatted report showing us all the top ranked macro events and top ranked assets that we're going to trade, and all the conditions, everything. Plus a bunch of other stuff in there in terms of a narrative and so forth, but also coaching, mentoring, and psychologist review of all the things that you need to pay attention to. You don't even get that in the professional reports, but you do get that with what we have. And you can get that by joining our Fat Tail community, link down below. Every morning. what does that report look like? Do you want to see it? Sure, I'll show you. Let's take a look. And I gotta see where it is here. I have it, the teleprompter version right here, so I don't have it prepped yet. But let me just bring it up, and I'll switch over to it. And there it is. All right. I'm just, there we go. All right. So I'll just do well, that's the VIX. That's not what I want to show you. I'm going to show you preview. There we go. All right. So this is the actual report, but this one is formatted for me for doing this show. So I'm just showing you exactly what goes on here. The report itself, the AI is extremely smart. So I just ask it for a macro report looking at all the macro events that happened since yesterday until this morning. And I wanted to also look at the economic calendar. I want to look at it at all the different issues that we're concerned about for putting a trade on, like the VIX, the volume profile, the market direction, all that stuff. And it goes out and finds all the most impactful macro events that happened and how they might affect our trade. And so then it creates this report, all of this, right? Although this isn't formatted exactly how you would see it, it creates a... Hey, you know what I'll do? I'll show you the actual... yeah, that would be better. I'll show you the actual report that comes out on ChatGPT. That'd be better, right? More better. So for me, it even created the teleprompter script. So I'll just go up here a little ways. So there's my prompt, and then here's the analysis. Right? You don't need to see all this other stuff. I'll just close that. And yeah, this is what I get every morning, and then I prepare it and I send it out to my clients. Of course, they can do it themselves, but I do it anyways. And it'll provide me with a macro report, all the events that are happening, and ranked by the order of impact, potential impact, and also the things that we should be trading. Right? Every morning. Plus, like I said, your own personal trading mentor and psychologist providing you with various things that you should consider. All right? So that's what happens every morning here. Thought you might want to know that. But anyways, let me get on to the report. It's all about volatility compression now. So the volatility surface has gone eerily still, with the VIX compressing to in the 17s, mid-17s, which is deep or very close to or just at the edge of the zombie land zone. Traders might be lulled into a deceptive calm. Now, this isn't the quiet of peace. It's the taut stillness before some sort of snap. It is the calm before the storm. And either we're going to have a breakout to the upside or a breakdown to the downside. That's typically what happens when volatility gets really compressed. Volatility starts doing this, and then it's like the Big Bang. When there's so little volatility, something has to happen, and then bam, right? That's the nature of the market, nature of the world for that fact. We also have the ADP report already. That came out yesterday. It delivered a market red flag. And so now all eyes are turned to this morning's unemployment claims. We want to see what that's going to provide for us. Will it confirm a softening labor trend? And we may be witness to a breakout in volatility from compressed lows. A tail risk traders and ignition queue. So those are the type of events that we're looking for. And of course, the top macro event this morning is the unemployment claims plus VIX compression equals a volatility spring setup. Wednesday's ADP miss shook confidence in the labor market resilience. With today's unemployment claims due, the risk is now binary. That's what I meant. It's either going up hard or down hard. It's a possibility that we could wind up with a moderate report, maybe that shows something improving. Maybe the ADP was off and unemployment claims come in hot or good. We don't know. Will it confirm weakness and reprice a recession risk, or revert higher and reinforce no landing optimism? What makes this setup uniquely potent for tail traders is the VIX compression signal. Sub-18 volatility in the face of major catalysts historically precedes volatility expansion burst. This creates a rare volatility springboard. Deep IV suppression plus macro catalyst equals an optionality jackpot if that rubber band does snap. So tail strategies thrive in this zone, especially those designed for volatility reversion and structural gap exits, such as one of our strategies that we call the convexity stack, and that is the 3 to 5 day tail risk strategy. And also this morning we're looking at the big ass fly on a morning trigger for that economic report, although we're now starting to get to, and you'll see this in a moment, the big ass fly is getting a little too expensive for it to be a good trade for us. Once the debit gets over a certain amount, then the risk to reward starts not being that great, and gamma starts getting up a little bit in our craw, and we're not happy with that. So we're right at that point where the big ass fly, we're just using it as a technical indicator, not a trade. So when you're in zombie land, we reduce with, but not conviction. When I say we reduce with, you'll see that in a second. We do that to guard against that higher gamma risk and that lower volatility, the acceleration of premium decay, which means that most of our trades now have less premium for us to go after in a zero DTE trade. But it sets us up for those other tail risk trades where we can start looking for super cheap options for an upside or a downside move. And that's where the tail risk trades come in, where we're now looking for way out of the money trades for those big risk events. And when they happen, they pay off big time. But the risk that we take is so super small that we never really draw down. So these are the environments where outlier trades explode. All right. So there you go. We're going to go now to the charts. That is not the charts. We're going to go to TradingView. And this is what I'm showing here is a more close-up view of the VIX that you don't normally see from me, but I wanted to show you the point of VIX compression. So this big move up here was obviously the tariff event when the VIX really exploded all the way up to 60. I mean, that was incredible. And then it has since petered out of gas and stayed elevated for quite some time, all the way through April and most of May. But now, in the latter half of May, we've been going sideways. And it looks like now that we're getting down to this next level. We've gone all the way through the Goldilocks zone, and now below the blue line is zombie land. And this is what we would call VIX compression, right? When this happens, it almost always, well, it does always follow some sort of event. It's an eventuality, I should say. So let me bring the entire chart into focus so you can see what I'm talking about. And you'll see every time there's a VIX event, we come down into zombie land, compress, and then go up again, right? Every time. Every single time. So here we are. the various VIX regimes that we have. Goldilocks zone here, chaos zone when we spiked way up, and then zombie land where eventually compression turns into explosion. All right, so let's bring the whole chart into view. So now you can see, there we are. We are compressed, and we should, like here, last August, where we had the compression and then bam, compression, bam, compression, bam, compression, bam, compression, big bam. Of course, all of these events are unknowable. They are essentially black swan events that happen at various frequency and intensity. Of course, the big ones, like what we had with tariff, and going back in August here, or going further back to other tail risk events like in 2015, 2008, the COVID crisis in 2020, etc. All of those are the bigger ones. Those are the big black swans. Some of them you might consider are not necessarily black swans, even though they're bigger events. However, they're still tail risk events, and we still trade them. So that's what we're really looking for. All of these spikes are huge opportunities for a tail risk trader. Those are the trades that you would normally miss because you're just not tuned in because you're putting on some weak ass spread or iron condor. And you're not getting these. You're saying, oh, I wish I had placed my trade for that. I could have made bucks. Well, that's what we do all the time. All the time. We're getting none of the cruft in all the big trades. Right? Wouldn't you like that? And then virtually no drawdown, and all big trades. Like, duh. Right? That's what we do. All right. So let's go on to the next chart, and that's we're still doing the 0 DTE. We can see that we're now looking at narrower flies, and that's due to increased gamma risk and also an increase in the rate of decay of premium, leaving us with less meat on the bone. So we have to reduce our risk by going to narrower flies, and that's the whole purpose of this classic out of the money fly with guide range, right? So now we're starting to look at 20 to 30 right in here. And what's our market direction? We usually pick up a directional bias with the 0 DTE trade and sometimes with the convexity stack as well. And so right now we have a directional bias that is bullish. With the convexity stack, we put it out of the money. We might play both sides of the market because it's so cheap. All right. And here, good indication of the compression over the past few days. Just going sideways. We're in this node just hanging out here, waiting to try to break out to the next step of Stairway to Heaven. Stairway to Heaven are the three nodes that are in the way to getting to all-time highs. All right, so today we're going to be looking for pullbacks into one of these structural levels that we look at through analysis of the volume profile. When that event happens in the morning, that's what these blue lines are, mapping out the morning session. We're waiting for a pullback. Obviously, nothing happened yesterday. Nothing happened the day before. We did get an event like that. This would have been Monday. And we did get an event here. We would have taken a long call fly here if we were situated for a long call, because at that time it was kind of a neutral bias, and so for most traders it would have been a coin flip. Would you have chosen the call fly? Would have you chosen the put fly? That would have been up to you. If you chose the call fly, then you would have made money. In any case, if you missed out on it, then it would have just been a very tiny little risk, and you can just write that off. So, where to go from here? That's that, and let's take a look at the volume profile, big picture. You can see here's the Stairway to Heaven steps, right? We're currently in step 1. We're looking to break out and get into step 2, and then use that as a launching pad to step 3, then break out to all-time highs. Been talking about this for a long time. We haven't had a clean breakout of this previous high over here. We had an attempt, and here a couple more attempts, are having a little trouble getting outside of that first node on step 1. All right. And we've been following this. If you've been following me, I've been following every step along the way. I called this the freedom node, then the top knot node, now stairway to heaven. I like to give it these names. It just makes it a little bit more interesting. Plus, they're good labels when I start talking about the volume profile to our client class. And also for you. All right. That's about it. All right. There's our report. You got the macro report. You got the 0 DTE layout. You know exactly what to do. You know the width. You know the structural levels to look for, and then you know the direction. That's about all. For the convexity stack and for the sigma drift, direction on the convexity is somewhat important, but typically we'll put a trade on both the upside and downside, never really paying more than, say, 25 to 50 cents for each, so our risk is super small. And if we do get a breakout, we get huge return. If we don't, then our risk is, like I said, super small. And that's how we play the game. All right. That's about all I've got. Hopefully this has been educational. Thank you very much. Coach Ernie, out. Did I go out? I thought I pushed the button. I didn't. Let's try that again. Coach Ernie is out.